These CEOs who recently traveled with our president there, putting our flags down in areas of industry and in countries where in some respects we haven't always had the greatest relationships with, because we see the eye on the prize of AI and all of these other technological advancements. And, if nothing else, this is destabilizing in some sense just to that effort. And then now we're dealing with this and the fallout from it if it escalates even further.
Yeah, but the key to your senses is if it escalates further.
Sure. I mean, the whole thing is a speculative if.
Yeah, I will recall when Soleimani was killed, it was going to be World War III. Donald Trump was a maniac and took out the head of the IRGC, and here we go. And it ended up, for lack of a better word, being not what was predicted. So I'm not saying that this is that, because this is pretty substantial, perhaps even arguably bigger than that. But to the extent that Iran responds in a manner that does not provoke or necessitate an even bigger response from the Israelis, again, on some of those oil facilities or refining facilities in the country, then perhaps we can move about our day and some of this will fall by the wayside. Again, the issue now becomes over the weekend, and this is part of the reason we're selling off, is who really wants to be long into what could be a substantial Iranian response. That's where your focus is. That's a duh statement, but it is true nonetheless.
The big question, obviously, is going to be, what our continued response is, how the White House itself is responding to now what is the retaliatory strikes by Iran. Our Eamon Javers is at the White House in Washington for the very latest on that angle. What do we know now, Eamon?
Yeah, hey, Scott, I'm actually in our CNBC bureau, and I can tell you that alarms have been going off in Israel this hour as the country has been bracing for this expected Iranian counterattack. TV cameras in Tel Aviv capturing images of Israeli anti-missile rockets launching toward incoming Iranian ballistic missiles in an attempt to intercept them and to protect lives and assets on the ground. It does appear, to the untrained eye, I should say, that at least one Iranian missile or fragment of a missile got through the defensive net and did impact on the ground in downtown Tel Aviv. But we'll wait for official Israeli confirmation of that and any word on potential casualties in Israel. Meanwhile, the Israeli military says Israeli fighter jets struck an Iranian nuclear site today in the Isfahan area, which they said dismantled a facility for production of metallic uranium and other infrastructure. And so far, Israel says it has struck more than 200 targets inside Iran, including Isfahan and the nuclear site at Natanz. And the military says that campaign is ongoing. I can tell you, we just got a little bit more detail here from the Israeli military. 200 missiles have now been fired in 2 salvos here. We're waiting for any confirmation now on any casualties in Israel. The Israeli defense minister now issuing a statement saying Iran crossed red lines when it dared to fire missiles at civilian population centers in Israel. We will continue to protect the citizens of Israel and ensure that the Ayatollah regime pays a very heavy price for its criminal actions. So this is clearly an ongoing campaign on both sides in real time right now, Scott.
With the threat of more escalation, obviously, given that statement that you just read from the Israeli defense minister passed on by our colleagues at NBC who continue to follow what's taking place in real time in the region.
Yeah, absolutely. And you think of this as a number of tiers, right? Because the Israeli effort last night clearly involves some sort of subterfuge, some sort of espionage in order to get assets inside, potentially drones inside Iranian borders and attack Iran from within. Also, deception in terms of luring Iranian officials into certain locations where they could strike them. I don't think we know all of the details yet about how that happened and what's going on precisely with Israeli forces on the ground inside Iran right now. Then you have the Israeli air forces over Iranian targets now. We're told that they are dominating Iranian airspace, which makes it difficult for the Iranians to fire these retaliatory strikes. And then you have this Israeli defensive effort over Israel, the so-called Iron Dome, to knock down any ballistic missiles that do get through either of those first 2 tiers of offense and defense. So this is a multi-layered effort by the Israelis. One of the big questions here is going to be how much American support is ongoing right now to this Israeli defense effort, and to what extent is the United States going to get drawn into this after the statement from Marco Rubio last night, attempting to distance the U.S. from this Israeli action, and the president warning against it late yesterday. Now on social media, sort of embracing it. Positive statements from the U.S. president about this strike overnight in Israel.
We're looking at live pictures as you're talking, Eamon, of Tel Aviv, in downtown Tel Aviv. I'm wondering as well, since you brought up the Secretary of State and the White House, what this does to the relationship between President Trump and Netanyahu, which at times has been close and certainly at other times has appeared to be more distant.
Yeah, I think we don't know fully as we sit here. We don't know how much coordination there was between the United States. The president has said today that he was aware of the Israeli intent to strike here, but that the United States did not participate in the offensive action. We don't know to what extent the U.S. Pushed back on that. There's reporting out of Israel that there was a green light, a sort of a tacit wink and a nod, if you will, from the United States. We need to understand that all better before we can look at the relationship between Netanyahu and Trump and understand really what happened here.
Eamon, thanks for the very latest. Come back to you as needed, of course. That's Eamon Jabbers in our bureau in Washington, D.C. Let's now bring in New Edge Wealth's Cameron Dawson and Capital Wealth's Kevin Simpson. Dan Greenhouse of Solus, of course, is still with us. Cameron, how are you thinking about all of this as it relates to where this market seemed like it wanted to go before all of this began?
It is easy to write off geopolitical events when we look at the long history of them and say that markets tend to look through them. But there are exceptions. And a really good reminder of an exception is a year like 2022. Russia invades Ukraine. Oil prices rally 35% through the summer. CPI hits 9.1% by the summer. The Fed is backed into a corner and has to accelerate rate hikes. And so the big question for us is whether or not this oil price move can be sustained. We are overbought in a downtrend, but if we start to see that trend change higher, it means that the Fed will not be able to deliver the rate cuts that so many market participants want. It means that we likely see a reacceleration in inflation, and now we'll have that really tough choice of, if we continue to see the labor market weaken, oil prices higher, inflation stickier, it looks a lot more stagflationary.
And again, it's a lot of ifs, obviously built into that idea, which may not come to pass. I mean, the market obviously is still expecting a couple of rate cuts this year.
Yeah, exactly. And I think that, to your earlier point, the move in interest rates is so very interesting because it is across the curve. You have the 2-year moving up, expecting that we're not maybe going to get those rate cuts, but you also have the 10-year moving up, which means that this bond market cares more about inflation than it cares about growth. And so if we see that 10-year yield continue to move up, it's another sign that the Fed is losing its degrees of freedom to be able to give the market what it wants, which again is trading at 22 times earnings. So there's not a lot of room to absorb bad news.
Is that what you think the move in yields reflects today as a result of what we're witnessing there?
Yeah, I think it's reflecting stickier inflation. It's reflecting the risk that you're not going to get rate cuts at the front end. It's reflecting the risk that if you do see that stickier inflation keeping around, we're not going to get deficits coming down in this environment. If we have to have potentially more military spending, that might be looking out a bit too far. But we think that this move is reflecting this worry that inflation just doesn't go away. And isn't it ironic, on the week that we had CPI and PPI missed to the downside, and a lot of people said inflation's gone and dead, and now we have this wrench.
Kevin, for somebody who literally is a professional hedger, I mean, that part of your investment strategy is built with that as the backbone. What are you thinking about right now as you watch this?
If not for what we're seeing on the camera, I would have agreed with everything that Cameron said. But the defensive playbook is we're going to buy gasoline, we're going to buy oil, we're going to buy defensive stocks, and we're going to buy treasuries. And it doesn't seem that that part's happening. Now, I don't know that the earlier trades this morning were as reflective as they are now, because the markets are responding immediately the way they should have this morning, which is we're seeing something that isn't just a little schoolyard bully pushing one another. This is something a lot more strategic by Israel. The good news is that they're not being pounced upon by other bullies in the yard. But Dan, your point in the beginning was the whole genesis of what comes next. Do you protect the oil infrastructure? And if so, then Cameron, we can have more conversations about rate cuts. We can put some of the inflationary fears in the background. But we'll have to wait and see over the weekend what happens to the oil infrastructure. That's what I'm watching.
You feel like doing anything in the market ahead, because it is the weekend, trying to game out where this goes into next week?
So we sold covered calls on Home Depot while we were sitting here preparing for the show. We had sold calls on Agnico Eagle because we got a big spike in gold, which you would expect when a geopolitical event like this happens. And then earlier in the week, having nothing to do with it, we sold calls on Apple because of the subsequent tepid meeting you had in Cupertino.
But what about where does the Home Depot move come in in relation to any of this?
It's just a premium. What we look for is when there's enhanced volatility, and you saw the VIX go over 20 today, we look at every position, and sometimes options misprice. And for whatever reason, and you look at even just the stable coin conversations today about some of the retailers, maybe it affected that space, but the covered call that we generated today had an annualized premium of like 16%. So we were playing a vol game there.
Are we in for now a renewed campaign of volatility?
Well, I mean, it's hard for vol to be too much slower than it was.
Well, it was 16. The VIX is at 20. There was a thought that, again, Brad Gerstner told me yesterday that this is a bullish environment. Now, this was before any of this happened.
Yeah.
AI supercycle, earnings were better than expected, tax cuts coming, deregulation, M&A, animal spirits, IPOs. What happened to that?
Well, I mean, we're not talking...
That was supposed to depress volatility.
Yeah, and that's been a fun conversation for several weeks and months now, but something's happening in the meantime. So I don't think what happened to that is fair. I think we obviously have to assess new information as it comes in. We have a pretty substantial, to Kevin's point, it's not two little pups. This isn't Equatorial Guinea. No offense to Equatorial Guinea. I mean, this is two real countries that have been on the brink of war for some time. So let's pay attention to it. But I think, to all of our points, I think we are emblematic of the uncertainty and the, not confusion, but I'll just stick with uncertainty, that exists. Because again, if this was all there was, then oil shouldn't be up 7% and the market shouldn't be off 2%.
There was a good feeling coming into today or any other day that people were too complacent anyway. That it was a foregone conclusion that with the S&P less than 2% from a high coming into today, that it was a foregone conclusion you're going to get there and beyond. Do you think people were too complacent about, not just geopolitical flare-ups, but kind of everything?
Yeah, when you're priced at 22 times forward, that doesn't leave a lot of room for bad news. And I'd flag that you had been starting to see things like high beta start to roll over. IPOs started to roll over a couple of days ago. Russell 2000 started to roll over a couple of days ago, all suggesting that at the margin for the last week or so, we've been losing some of the risk on momentum, which just kind of gets catalyzed even further by negative news headlines like today.
Last quick thought, Kev, before I got to move on.
I mean, there was also a foregone conclusion that Israel was going to attack Iran, and I think we knew that yesterday. Another reason we were talking about RTX and buying Raytheon in advance of that. So I don't think it comes as a surprise, and the good news is we were aware of it, whether we had contributed or not. This didn't come as a surprise, and hopefully that tempers what happens over the weekend, and we're having a much easier conversation on Monday.
All right. I appreciate everybody being here. Dan, Cameron, and Kevin, thank you so much. We're continuing to watch oil prices. A big story today, obviously, is tensions flare in the Middle East. Let's send it now to Pippa Stevens, who's tracking that move and has been throughout this day. Pippa?
Hey, Scott. Well, oil is now around the highs of the session following Iran's retaliation on Israel, although it does remain below its overnight high after WTI at one point jumped 14%. Now, the market does remain focused on the fact that so far no oil supply has actually been disrupted, with several street firms saying prices cannot sustain these levels unless barrels actually come off the market. Iran itself is not a major supplier, exporting about 1.7 million barrels per day, but the fear is that a wider conflict could disrupt the region's oil supply, including possibly from Saudi Arabia or Iraq. But the biggest possible impact could be a potential blockade of the Strait of Hormuz, with about 20% of global oil flowing through the key waterway every day. CIBC Private Wealth's Rebecca Babin said it's still a low probability scenario, but that the odds are rising as the situation evolves. Scott?
Pippa, thank you. That's Pippa Stevens. Coming up next, more on this late session sell-off. We are about at the lows of the day. Charles Schwab's Liz Ann Saunders standing by on the other side of the break.
Testing, testing. Audio test. Why is this thing not working?
Out to everyone, in Israel, because this is obviously, not what anybody wanted, but I guess what had to have happened. And so now, where we are is that, as a trader, it depends. The easiest trade in all these things is always to be long, heating oil cracks, which obviously rallied tremendously today in gas oil. And again, the safest part of the thing would be basically long, the refinery spreads. Where we go from here, my mind is really preoccupied with the people in Israel, and I'm really concerned about what goes on there. But it's a very, very tricky, and there's too many wild cards here to really say what can happen from here. And I don't want to go ahead and put myself in a limit.
I understand. When you hear the Israeli defense minister say that Iran crossed a red line by going after civilian areas, does that only ramp up your expectation that oil has the risk of moving higher because it just further raises the stakes of an even larger escalation now and a response to that by Israel?
Well, that's absolutely going to happen. The question is, this is not three-dimensional chess. This is eight-dimensional chess. Obviously, Israel's response is going to be, even more catastrophic for Iran. And where we go from here in terms of what's Iran's next move? Do they go ahead and do something in the Strait of Hormuz? Do they do something against U.S. military assets, whether it be in Iraq or in Israel or anywhere in the Middle East? Does the Houthis, respond in some crazy way? There's too many variables here, and obviously, my mind's not really thinking properly because obviously this is a very sensitive subject for me. But if I'm looking at this, trying to be objective, the risk reward here is refinery spreads, because that's the most straightforward, most liquid way that in terms of where we are to what we could be. Because if I'll tell you one thing though, I really think that. And I'm not a stock guy, and that, and I never professed to be a stock guy. But if I was a stock guy and there was a way to buy, the Iranian stock market over the next week, I would do it, because it can't get much worse. And if this situation ends the way I think it's going to end, I think the Middle East is going to be a lot better off. And the time to buy something is when it can't get much worse, and that's probably what's going to happen in Iran.
When you look at the possibility, I think when people look at the situation there and they think of, well, what could be a real game changer in terms of the price of oil is if, as you said, the Strait of Hormuz gets closed down. What do you think the likelihood of something like that is, rather than just suggesting it or speculating about it? Do you think it's anywhere close to a possibility that something that dramatic could happen?
I'm an energy trader. I'm not a military specialist, and I don't profess to be. So, my viewpoint on what the probability of the Strait of Hormuz being closed is no better than someone else's. But I will tell you what will happen if that happens. I can't assess the probability, and that's why that's not in my wheelhouse. But I will tell you, it's pretty obvious what would happen if that happened. I do think, though, that. Who knows what else, desperate people do. Desperate people do desperate things. I don't know what else is in the Iranian arsenal, what they would do to, to their neighbors, to Saudi Arabia, to UAE. I have no, there's too many variables, and I'm too concerned about civilians. And I think that if you look at it, if I'm looking at it objectively, okay, and I'm trying to step back, to me, the risk reward trade is in products, in heating oil spreads, gas oil spreads, and cracks, because that's basically probably where you're going to lose X to make 2, 3, 4X. And it's already happened today, by the way. So who knows? But I don't really know I'm not a military expert. I just know what would happen if something. I just know what would happen if this happened, but I can't assess the probability of anything happening. And that's way outside my wheelhouse.
Understood. I just was curious as to how if you think about certain trades and you try and model in certain outcomes as many do, if that was into your legitimate calculus or not. I'm going to let you run, Mark. I so much appreciate you calling in and sharing some of your views with our viewers, given how well you know these markets in that area of the world. That's Mark Fisher of MBF. Let's bring in Schwab's Lizanne Saunders now. She joins us on the CNBC Newsline. It's good to have you on as well, Lizanne. Welcome back.
Thank you.
Your thoughts on these markets?
Yeah, I mean, it's not a huge reaction down. We've had obviously worse days just tied to trade news, but if you look historically at other surprise military attacks, you do tend to see a big downward move on the day. The two biggest ever were most recently September 11th, maybe no surprise there. And then when North Korea invaded South Korea, you had both about 5% drops, so much more significant. And then it's a question of what happens to oil prices. Is it on a sustainable basis? For instance, September 11th, you had the spike in oil prices initially, but then oil prices rolled over as recession fears took hold. Turned out we didn't know at the time we were already in recession. So it's the sustainability of the oil price move, and does it add to downward pressure on the economy that ultimately defines how much worse it gets for the equity market. Outside of that, you tend to see fairly quick rebounds.
I'm thinking about what Cameron Dawson said, making the case that this potentially puts the Fed in a box. They're stuck because if you do have this escalation of the tension in and of itself, if you do have oil prices continuing to rise and thus you're once again worried about an inflation picture that seemed to be all but tamed to this point, then you now have to introduce the idea that you don't have the Fed on your side as you thought you did just 48 hours ago.
Well, it's a question, though, of the growth side of the equation, too. So, yes, all else equal, this puts upward pressure on at least headline levels of inflation, less so on core levels of inflation. But even within core levels of inflation, you've got forces moving in the opposite direction. You've got the prospective force on the upside of inflation tied to tariffs. That's still somewhat unknown. You've got the downward pressure coming on the shelter components of core CPI. But now you have this headline pop on the upside. But sustainable moves up and oil put downward pressure on growth. It starts to impact the labor market. That might give them the leeway to start to ease. But you might be in a situation, you're absolutely right, where their dual mandate, each one is moving in the opposite direction, and it does put the Fed potentially in a bit of a pickle.
Sounds like, if nothing else, you would not be surprised in any way by an increase of volatility in the days, certainly, but maybe even weeks ahead.
Yeah, no, that's kind of a no-brainer. I think we were facing volatility anyway, just because of the move now between here and July 9th, when the reciprocal tariff extension expires, potential court rulings, and now this. So, yeah, I think more subdued volatility recently. I think that ship sailed for now.
Lizanne, I'm going to let you run. We rely on people like you at times like these. Thanks so much for coming to the phone. Lizanne Saunders of Charles Schwab. I want to go back to Washington now. Our Eamon Javers has more. Eamon?
Scott, a couple of updates here from Israel and then also from the United Nations Security Council, which is meeting now. From Israel first, the IDF, the Israeli Defense Forces, are saying to Israeli citizens that they can leave their secured facilities for now. The guidance they're giving to the Israeli public is stay close, though, to those bomb shelters and other secure areas, but you can go and move about and leave the actual shelter right now. Now, the IAEA chief has been speaking to the UN Security Council with some updates on exactly what's going on with the nuclear facilities in Iran. The UN Security Council meeting getting information that there is no indication of an attack on the underground enrichment halls at the Natanz facility inside Iran, but the attack on the power supply there may have damaged the centrifuges. So no indication of an attack on the underground facility there, which is extremely hardened, but that there does appear to have been an attack on the power supply, and that may have damaged centrifuges there. Also, that there is radiological and chemical contamination inside the facilities at Natanz. So that is something to keep an eye on. The radiological contamination, we are told, is manageable with appropriate measures inside that facility. The IAEA chief Grossi additionally telling the Security Council here that the above ground plant where Iran was producing uranium that was enriched up to 60% uranium, that has been destroyed. So some information now coming to the UN Security Council. Also, Reuters reporting just within the past couple of minutes here that President Trump spoke today with Israeli Prime Minister Benjamin Netanyahu. That's according to a White House official coming from Reuters. That, presumably no surprise as we continue to look at pictures coming out of Iran here, Scott. So the picture as we have it now is damage to an above ground facility in Iran, damage to an underground facility in Iran that appears to have been done through a power source, and that facility seems to have been damaged. Centrifuges there seem to have been damaged, and there is contamination, radiological contamination at that site, but that is deemed as of right now to be manageable. Scott, back over to you.
I'll come back to you one more time on the issue that we spoke about prior. As we watch those live pictures of downtown Tel Aviv and what the Israeli defense minister suggested were civilian targets and that thus crossing a red line. When speaking with a trader and one so astute and established like Mark Fisher, for example, hard to even focus on the market itself and what the ultimate reaction could be in the markets, because your focus and concern turns to the real possibility now of escalation in what's already sort of trending in that direction, thus complicating this whole situation even further, and how the United States might respond to that.
Yeah. I mean, first of all, Scott, your heart breaks for the potential loss of human life anywhere as you watch this, and you've got to keep that first and foremost in your mind. But then, as you sort of try to understand what the geostrategic implications are, and certainly the global financial market implications are of all this, it's just difficult to get your arms around it in real time because the event is ongoing. So you don't know what it is that people are going to be reacting to tomorrow because you don't really know what's happening. You should always bear in mind this idea of both fog of war, which is that it is confusing to read these things because, we have certain live cameras. We're speaking to certain officials in Israel and here in Washington, but we don't have total information awareness of what's happening. And then the other element is intentional deception, right? There's a lot of intentional deception that takes place in any event like this. And so you may be following the misdirect and think you understand what's going on, but you may not have the full picture. So I think, there's an element, we as commentators and observers and reporters on this have to have an element of humility to admit that, we don't have total visibility into what's going on here.
Sure. Eamon, thank you very much for that. Eamon Javers again with us from Washington. We'll come back to you again as needed. Up next, Mohammed El-Arian. After this break, we'll find out how he is going to navigate all of this in this developing story that has the market down, the Dow down 800 points below its 200-day average, 200-day moving average. S&P gives up 6K. We're back after this.
Again, rated PG.
We're back now on Closing Bell. Joining me now is Allianz Chief Economic Advisor Mohamed El-Erian. It's good to see you, and thank you so much for being with us. Mohamed, how should our investing audience be thinking about this?
Well, first, as you said, Scott, and thanks for having me, lots of ifs. Having said that, I think there's four clear things in my mind in terms of the economic effects. One, this will accelerate the ongoing slowing of the global economy. Two, it will limit policy flexibility even more, including for the Fed. Three, it will remind companies that their supply chains are really uncertain. And finally, as you've discussed, it is eroding the role of US Treasuries in the global system. So the magnitude of all this will depend on the duration and scope of what's going on right now, but I think the direction of travel is very clear on all four of these things.
What do you make of the move in yields? Can you expand on that? They're certainly not acting as they normally would, as history would suggest they should.
Absolutely correct. And you had a debate. Is it because people are worried about the inflationary impact of higher oil prices, or is it something deeper? I believe it's something deeper, because it's been happening all year, Scott. Yields haven't been behaving normally. They have gone up during days of risk off. They've gone up during days of risk on. We are seeing foreign holders buying gold. And what's happening is something actually quite fundamental, is that the role of the US at the core of the system is being eroded. And when that happens, the world finds out it's overweight US Treasuries. It's overweight the dollar. And there's little appetite to become more overweight. So you don't get the buying that we used to get in the past. The good news for the dollar is there's nothing to replace it. So people can only reduce their dependence slowly over time, and they have to do it buying many other assets. So it's a gradual process, but it's one that the US should take really seriously.
So you're saying that where there was speculation over the last many weeks on the idea of a flailing U.S. exceptionalism, that this is evidence for maybe the very first time concrete in a true time of what is perceived to be global crisis of any level, that is a confirmation of your view?
Yes, and I would qualify it in three ways. One, it's not the first evidence. We've had quite a few smaller ones. This is the really visible one, and I think that is important. Second, it's about two things. It's about the loss of exceptionalism, but it's also about policy unpredictability. The good thing is that foreign investors are making a distinction between the sovereign side and the high-quality corporate side. And they're not extending their concerns about the sovereign side to the high-quality corporate side. And that's really important. And the third issue is just recognize this is a slow-moving process because there is no ready substitute for the dollar. So it is going to be going on for a while. And I stress again, the world is overweight the US. It's overweight treasuries. And once you lose trust, then you are looking to reduce this overweight, but it takes time.
The other thing you said I find very interesting is almost pointing to an extraordinarily tricky situation for the Fed, one in which you predict, of course, as you said first, that it's only going to accelerate a global economic slowdown, but also one that limits the Fed. That's how you described it just a moment ago. What do we do in that scenario? If we have a faster, slowdown globally in the economy, a Fed that can't do much about it, then what?
So absolutely no policymaker likes the notion of stagflation. And that's what higher oil prices do. They lower economic activity and they increase inflationary pressures. So whenever you see stagflation, you know that it's going to put policymakers in a difficult situation. And that's not just monetary policy, but also fiscal policy that we don't talk enough about, because this will make revenues lower and expenditures higher on the fiscal side. On the monetary side, already the Fed was delaying rate cuts. this Fed will become even slower in delivering rate cuts because it has been shaken so much by its big inflation mistake. So it is more likely to risk a slowdown than risk an inflation. Whether that's the right thing or not, we can debate it till tomorrow morning, but I suspect this is what this Fed will do.
Do you think that now that this is all unfolding, and that is your clearly stated view, that this would cause the administration and the president to capitulate even further on where their tariffs currently are?
I don't know, because I don't know what the basic objective of tariffs are. If it was escalate to de-escalate, and you want a fair trading system, you can do this later. If, however, it's to raise revenues, if, however, it's to reshore manufacturing activities back to the US, then you should not ease on tariffs. So as long as we don't have clarity on what the primary objective of tariffs are, I find it very hard to answer that question, Scott, unfortunately.
Mohammed, I appreciate it very much. Thanks for sharing your views with us, Mohammed El-Arian. We're all over the sell-off, as you know, as we head towards the close. As we said, the Dow Jones Industrial Average below the 200-day moving average. The S&P 500 giving up the 6,000 level. Mike Santoli's waiting in the wings. We're 10 from the close. We're back after this.
We might see a drop here next 8 minutes or so to this 200 here. 1546, 1550 area.
This is the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli and 314 Research's Warren Pies are here to break down these crucial moments of the trading day on what has been a very busy day of breaking news for us. Mike, you want to put it into some perspective for us as you watch these markets?
Yeah, pretty decent little test of the dip buying reflex. And it looked like it was going to be a real pure example of that by midday. And then we get the retaliation. Now, structurally, not a lot has changed in terms of this market, in this modest pullback zone. It had sort of decelerated on the way up, too. We got within a couple percent of the high. So it seems as if, this is could be just kind of reloading the market, frankly, and doing what it was supposed to do anyway. But it did bring home that we had too low a risk premium in the market after this run, just for the potential range of outcomes. So VIX going above 21 next week. You got maybe some bumps to get over when it comes to the Fed meeting and, some various expirations. So I do think that we have to be mindful of the fact that we've come a long way, but we've not even broken the 20-day moving average in the S&P 500.
Yeah, Warren, how are you watching all this?
Yeah, I think it's not surprising to see that we're kind of weak going into the close. Nobody really wanted to hold risk going into the weekend when, headlines could flare up. But overall, I think we have to take a step back and a deep breath. And I heard a lot of the guests previously, worried that the Treasury market's not acting how it's supposed to. I'm not so worried about that. I think that we've had a nice rally in bonds and we're kind of selling off a little bit. Not surprising given the fact that oil's spiking. I think all you need for the bond market to really work and for the equity market, for yields to stay in a place that works for the equity market, is for the market to believe that there's still like 5 to 6 rate cuts ahead of us. And I think the Fed's going to confirm that next week with their SEP, their June SEP. So I think I think what Mike said is right. There's some fear that's coming back in the market. Obviously, if we get worst case scenario geopolitically, then all bets are off. But the history of these kinds of conflicts, and this is oil's the market I started my career in, the history of these kinds of conflicts is that they fade in relatively quickly.
I mean, that is the view, Mike, and nobody is as historically astute on the markets as you, as we find every day.
Well, I mean, it's one of those things where at some point, one of these conflicts is going to spill, beyond containment, and it's going to have broader implications. But even if you look back at, the Russian invasion of Ukraine. Now, obviously, the Fed was hiking right into that. You had massive concerns about this explosion in inflation. It really was reinforcing of this idea that the macro was getting out of hand. I'm not sure we're in that same boat here because of the starting points. Again, oil being depressed before this little pop. Yields, I've not been alarmist about the absolute level of yields. Yeah, it looks as if maybe there's a little slowness to migrate back toward treasuries in a pinch. But to me, the broader asset markets are not in panic mode, and it's not as if bonds are sitting it out. So I think that's why I'm a little bit less concerned about that. That being said, again, look, we rebuilt the valuations. I don't think sentiment has gotten over its skis, but it's certainly not as fearful as it was a little while ago. And you have to be aware that after a 25% run, the risk reward is probably flattened out a bit.
Let's be clear. The S&P 500, Warren, is only down 1.2% today. So the market has managed to afford itself rather well in what on television looks pretty bad, obviously. We're still within 2-3% of an all-time high. And it sounds to me like you think that march towards it doesn't get interrupted for very long.
Yeah, as I said, nobody knows if we're going to have the worst case scenario, but nothing has really changed. The supply-demand equation for the oil market hasn't changed. There's been nothing, no supply has been impacted. We run studies every week for our clients, and I just have a catalog of bullish technical indicators. The market's message is bullish, and I don't see a ton of buy-in. Sentiment has not gotten stretched. We had a study for our clients this week. I had more bears than bulls last week. Yet 2-month momentum was above 10%. That's like a 1% in all of history kind of occurrence. So, and then we have forward 12-month EPS is about to hit a new all-time high. These are the kinds of things that if you want to look through the headline stuff that scares you and focus on the core of the market, which still is healthy.
You can hear the clapping here. The bell's going to ring. It's going to ring us off the lows, too. It's still going to look like a nasty day, but below the surface, it's maybe not quite as nasty as the overall numbers would suggest. The S&P is going to close below 6,000, as I said, and we did give up the 200-day on the Dow. Whether we close above that, I think, is still in some question. We'll continue to follow that into overtime with John Ford.
That bell marks the end of regulation. Voya Investment Management ringing the closing bell at the New York Stock Exchange. Microsoft doing the honors at the NASDAQ, and stocks falling today as Israel launches a wave of airstrikes against Iran and taking a leg lower late in the session as Iran responded with missile attacks aimed at Jerusalem and Tel Aviv. The Dow with the biggest drop among the major averages, though that's for some other reasons. Today's declines dropping all three major averages into the negative for the week. Financials the worst performing sector today, especially the payment companies. Visa and American Express among the biggest drag on the Dow. This on reports Walmart and Amazon are considering their own stable coins for customers, which could replace some of the services from the payment companies. The best performing sector is energy, unsurprisingly, the only one in the green as oil prices spike. Money moving into gold, sending it back toward the all-time highs from April. But investors selling bonds on fear spiking oil prices will lead to inflation. That's sending yields higher. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort. Morgan Brennan is off today. Let's begin with the latest out of the Middle East. This afternoon, we watched live as Iranian missiles headed toward Israel in response for last night's strikes by Israel on targets in Iran. Let's get to our Eamon Jabbers in Washington. Eamon.
John, that's right. We're learning a little bit more now about U.S. involvement in all this from NBC News' Pentagon team, reporting now that the U.S. is assisting in shooting down Iranian missiles and projectiles that are targeting Israel. That's according to 3 U.S. officials per NBC News. They're also giving us a little bit of background on what exactly the U.S. is using here, saying that the effort by the United States is using ground-based interceptors, including THAAD and Patriot batteries. Both of those are missile interceptors, and we know that the United States has moved assets into the region over the past couple of days to reinforce the robust U.S. military presence that was already there. Additionally, just within the past hour, John, as we're watching these pictures, we have seen a statement here from Benjamin Netanyahu of Israel posted to YouTube just within the past hour. It's significant because it is an explicit message to the Iranian people and a call for regime change. There you see Netanyahu giving this message. He says, the Islamic regime, which has oppressed you for almost 50 years, threatens to destroy our country, the state of Israel. The objective of Israel's operation is to thwart the Islamic regime's nuclear and ballistic missile threat to us. As we achieve our objective, we are also clearing the path for you to achieve freedom. He goes on to say, the regime does not know what hit them or what will hit them. It has never been weaker. This is your opportunity to stand up and let your voices be heard. So an explicit now appeal from Benjamin Netanyahu to the people of Iran themselves directly, calling for regime change, calling for people to stand up and change the government, and saying that the regime currently in place has been oppressing the Iranian people, and saying that the Israelis are friends of the Iranian people but opponents of the Iranian regime. We'll see if that has any resonance inside Iran. We don't know, John, at this point, how much damage Israel has done to Iranian command and control of their military or to their political system. Clearly, a number of high-ranking military officials inside Iran have been killed. That may be disrupting Iran's ability to respond militarily here. And now with this additional pressure from Netanyahu calling for, in effect, civil uprising inside Iran, that may further complicate matters for the regime in Iran. John.
Eamon, you gave us a sense of U.S. involvement in shooting down missiles, Iranian missiles incoming into Israel. From there in Washington, any sense of European response or reaction or knowledge beforehand of what Israel was doing in reaction to Iran's response?
Yeah, we don't have any indication, or at least as I sit here, I should say, I don't have any indication that European officials knew in advance about this. But we have seen some statements, and I'm just looking to see if I can call one up here in real time. We have seen some statements from European governments supporting Israel's right to defend itself and saying Israel has every right to do that, but sort of limiting their statements to that and not going farther in terms of, does Israel have the right to conduct regime change inside Iran, for example? Well, there's a lot that we don't know about this, and the situation is ongoing now. We don't know what forces Israel has on the ground inside Iran, what capabilities they have inside Iran. Clearly, they're much more capable inside Iran than the Iranian regime understood as of yesterday. The question is, what is Israel's intent here? Is this message from Netanyahu simply propaganda designed to put pressure on the Iranian government, or does Israel intend to push for regime change in Iran? That is, very tricky business, as we've seen over the past several decades. And, we'll see where it goes, obviously.
Indeed. Eamon Javers, thank you.
You bet.
Let's turn now to today's market action. Stocks closing near session lows. Only 2 Dow stocks and 1 sector, energy again, closing higher with the broad-based selling. Joining me now is Bob Elliott, CEO and CIO at Unlimited Funds, and Krishna Guha, Evercore ISI Vice Chairman. Guys, welcome. Bob, oil moved dramatically today off a pretty low base. Stocks moved modestly. I guess this is more about what are we set up for given the run that stocks have been on. We're pretty near all-time highs on the S&P.
Yeah, I think in a lot of ways the market action more broadly is reasonably muted because I think there's a lot of questions here about how far this will go, whether it'll be, a tit for tat and then wrap up the way we've seen in previous instances, or whether this is going to be a more extended conflict in the Middle East. I think the thing that it highlights for most investors is that they're pretty unprepared for a war-like environment, right? Most investors holding 60-40 looked at the screens today and they saw both their stocks and their bonds selling off, with really the only asset providing true diversification in this moment was gold.
Gold. You're like Rumpelstiltskin, only, without the hair obsession. You have good hair already. So what is it about commodities in these warlike times that investors should pay attention to?
Well, I think it's really a twofold issue. One, of course, anytime you're engaged in a conflict with an oil-producing country, there's the question about whether those assets will get hit. And there's some ambiguity. So far, there's no indication that those meaningful production facilities are being hit, but there's been some rhetoric late in the afternoon that suggests that maybe the opening up of conflict associated and targeting oil production facilities, given the retaliation of non-military targets that were hit in Israel. And so that's a real question there. The second, probably bigger issue, if you're sitting in the U.S. Economy, is that rise in oil prices combined with the fact that we got a reaffirmation of 55% tariffs from China. That adds up to a pretty concerning picture on the inflation side as the Fed meets next week and pencils out its monetary policy through the rest of the year. It's going to be a lot harder for them to deliver the sort of cuts that many people expect in an environment of rising oil prices and elevated tariffs for longer.
Sure. Krishna Guha, there was a time when missiles flying between Iran and Israel was a nightmare scenario for markets. I'm not sure if it's getting how the markets have through the Russia-Ukraine conflict, the Hamas-Israel conflict, or a combination. It doesn't seem to be the case this time that this is being taken as that kind of a nightmare. Are investors too complacent?
So I'm not sure investors are complacent, but I think it is clear that the market is not at this point discounting odds on for a full-scale war. The market is pricing a more limited series of engagements and some risk of escalation into a full-blown conflict. In particular, as your previous guest has just noted, we haven't yet seen actions that directly target oil. We haven't seen the Israelis strike major Iranian oil installations. We haven't seen the Iranians threaten to or attempt to either strike Saudi or Gulf facilities or, which was always the most feared action, try to close the Straits of Hormuz. So right now, the market is, treating this as an engagement that is more serious than those short tit-for-tat episodes that preceded it.
but that is probably not going to escalate into full-scale conflict. That may or may not be correct.
So in a world where we already have these tariff turbulence moments in 2025, how does this affect the global picture as you see it for risk? Is risk particularly more pronounced now, Krishna, in some places versus where it was before, or is it too soon to make any shifts in your calculations and what you expect might happen?
So it's probably not a moment to overreact, right? Because we don't know how far this conflict is going to go and for how long. I think it does seem clear that this is not a one-day, one-time wonder of the kind that the market has absorbed quite well over the past year. Looks like something that's going to, and even in the baseline case, continue potentially for several weeks. An extended Israeli bombing campaign attempting to degrade Iran's nuclear facilities, but potentially, as your correspondent noted, more try to push for regime change. In the end, of course, the only sure guarantee would be for Israel would be a friendlier regime in Iran. So lots of big unanswered questions, but we don't know, whether we're on that path of ongoing escalation or whether after a period this thing will cool down. I do think that investors have to recognize that if we were to see a sustained and significant increase in oil prices on top of the shock from tariffs, that is adding stagflationary pressure to an already stagflationary shock coming out of tariffs. That has to be bad news for growth, and inflation has to further complicate the Fed's life. Just don't expect the Fed to jump to quick conclusions when the geopolitical side, the military side, is still so fast moving and uncertain.
Echoing, Bob, what you just said. Now, Bob, you talked about the danger in this environment to the 60-40 portfolio. A lot of investors right now have something a lot closer to probably a 70-30 portfolio, given the run that stocks, that equities have been on over the past, not just several quarters, but several years. Also, given the strength of some of the large technology stocks, how much danger is there, if there is any additional, in that weighting toward larger technology stocks, toward being so much overweight equities in this environment?
I mean, at the big picture level, equities at these prices are still implying quite strong growth ahead. And the combination of the higher tariffs and the risk of an oil shock call into question whether that strong growth is going to actually play out into the future. And I think one of the things when you're looking at, if you're looking at, maybe you still are not so concerned about the economy, maybe this will be a transitory story, you can get access to growth exposure without necessarily having to buy equities at all-time highs. Take high-yield spreads. Even today, high-yield spreads traded basically flat on the day, in a day when stocks are down. I think they represent the fact that as long as we don't get into a world where there's a significant economic contraction, those might be a better place to park your capital and take a little capital off the table from stocks at all-time highs.
Krishna, how much does this complicate the second half of the year and consumer spending power if these oil prices stay high?
An oil price increase is like a tax hike on consumers. And we've already seen consumers, of course, turning a bit cautious in the face of trade wars. You've seen precautionary savings move up and seen consumption a bit softer than it was late last year. Not outright dangerously weak, but softer. If oil prices stay high, then you're going to likely see some further softening on the consumer side. Of course, the U.S. is, roughly speaking, self-reliant in energy and oil. So one would expect that these impacts over the whole economy would be more serious in Europe and Japan, let's say, where there isn't an offset of people working in that industry, firms in that industry benefiting just the oil tax that everyone has to pay.
Duly noted. Krishna Guha, Bob Elliott, thank you.
Thank you.
Well, coming up here on Overtime, we'll continue to follow this fallout from the Israeli strikes and Iran's retaliation. We're going to look at oil jumping to its highest levels since late January. Could it head even higher if this conflict drags on? We'll be back in 2.
finding insurance.
Welcome back. Markets fell as Israel strikes on Iran played out. Oil spiked, though, to its highest level since January. Joining me now are Halima Croft from RBC Capital Markets and CNBC's Pippa Stevens. Halima, there's a lot of talk about the Strait of Hormuz, a very narrow passageway from the Persian Gulf out into the ocean. I think, something like a quarter of all, a fifth of all oil consumed globally passes through here. Iran might not shut it down, but why is it such an important choke point?
I mean, it is the key choke point for oil. And I think a lot of the conversation today has been, well, Iran hasn't closed the Straits of Hormuz this morning right after they sustained a massive attack targeting their top generals. Let me fade this story. And I would just remind people that we did see a long time ago in the 1980s, during the Iran-Iraq war, there were multiple attacks on tankers in the Straits. Hundreds of tankers were attacked. You did have the Straits mined, and the U.S. actually had to reflag Kuwaiti tankers to get them through the Straits. So there is a historic precedent of disruption of maritime traffic within the Straits of Hormuz. Again, we have not seen that for a while. But in 2019, after we reimposed maximum pressure sanctions on Iran, 2 tankers off the coast of Fujairah, the main UAE port, were hit with mines. They weren't sunk, but damaged. But there was a view at the time, and if the Iranians had wanted to sink those tankers, they could have done so. So again, I think we should not entirely write off the risk of the Straits of Hormuz. And I don't think we should set it up as a straw man either. Just because they may not close it doesn't mean if this conflict doesn't escalate that they will not disrupt traffic there.
And it's globally important, Pippa, right? I mean, even though, as Krishna Guha was just mentioning, the U.S. now has quite a bit of access to our own oil, China relies quite a bit on Iran.
That's right. So about a third of all the oil that's passing through the Strait of Hormuz is actually now going to China. And so that does mark a little bit of a shift in how the global oil flows are now shaping up. And that also does then beg the question, what is going to be the nature of Iran's response, given that China is now so reliant, their teapot refineries especially are so reliant on buying that. And of course, they have been overlooking some of these sanctions, the maximum pressure the U.S. has imposed on Iranian oil. And so if they're the only buyer, you don't necessarily want to cut off the one person that's buying your oil. But I guess also, Halima, to your point, even if the strait itself isn't closed, how quickly could we see disruptions from things like insurance costs spiking for tankers 100%. Because people don't want to send their ships through
the risk of going through there. And we had the UK Navy yesterday talking about canaries in the coal mine that we may not have paid attention to. UK Navy was out yesterday warning about going through these key waterways because of potential military engagement. So again, I think it's too early to entirely fade this story on the Straits of Hormuz, because the Israelis have already signaled this is going to be a multi-week operation. They've just come out and called regime change a key goal of this operation. If you are the Iranian leadership, you are now facing an existential crisis. So you may not care as much in the short term what China needs. You may decide you have to raise the cost, essentially internationalize the cost of this conflict for everybody else. How do you do that? Disrupt energy supplies. Again, we're not saying that's going to happen, but we have seen past precedent of the Iranians targeting energy facilities in the region.
So, Halima, what's China incentivized to do itself?
I mean, China wants to de-risk the situation. But again, a lot of moving parts. It's unclear what influence they would have over the Iranians at this stage. Again, I would also be paying close attention to Iraq. Part of the reason why we drew down our embassy in Baghdad was a concern about the security environment there. There are a number of Iranian-backed militias in Iraq that have targeted U.S. personnel in Iraq, but they pose a clear and present risk to Iraqi oil infrastructure. They are located in the south, close to Basra. Iraq produces about 4.4 million barrels a day. That oil is at significant risk in an intensification situation if the Iranian leadership is coherent enough at this point. Because again, we don't know what the command and control structure of the IRGC looks like right now. They've lost their top commander. They've lost the commander of the Quds force. So do they have the personnel ability to retaliate in this manner? But if they do, watch for the proxies. Look to Iraq. Look to the Houthis. The Houthis retain ballistic missile capabilities. Do they start firing cross-border?
So, Pippa, global contingency plans. Are there other routes, shipping routes, that we would expect for logistics chains to start looking at implementing, even with the chance that the Straits of Hormuz might be impacted?
So you can go around this, the tip of South Africa, but that does add on significant time and then also significant money because you're paying a lot more for your fuel. And especially with oil prices higher, that bunker fuel will cost more. And so I was talking to Kepler earlier today, and they said that so far they're not seeing any disruption to the ships. Everything is looking normal as per usual in the Strait of Hormuz. But I think that the longer this escalates and the more there is some perceived sense of risk, then maybe we will start to see some oil flows diverted. Saudi Arabia has invested heavily in a pipeline that's east to west, so they can export through Yanbu and then avoid the Strait of Hormuz and then export to Europe. So maybe we'll see a little bit more volumes there.
The one thing I would remind viewers, though, in 2019, again, when we started to see Iranian attacks in response to maximum pressure sanctions, they first hit those tankers off of Fujairah, which is outside the S-curve of the Straits of Hormuz. So everyone said de-risking Iran. But the Iranians also did a drone attack on the east-west pipeline as well. So again, they showed they had the capacity to hit de-risking infrastructure. That was 2019. The command and control structure of the Revolutionary Guards was in much better shape than now. So again, that is an important caveat. But we should not be complacent about the Iranians' past ability to hit this infrastructure.
What's the path to de-escalation?
I mean, the path to de-escalation is the Iranians essentially saying that they just are not up for this fight at the moment. And so taking whatever deal potentially is offered to them by the Trump administration. Again, it looked like there was a deal on the table if they opted for zero enrichment. The Iranians were balking about that. Question is, at this point, are the Iranians going to come to the table? Are they going to try to convince us it's time to climb down? Again, odds are not on the Iranian side right now.
And given that, you mentioned that the Iraqi infrastructure is at risk, what about Saudi Arabia? Because ever since relations have normalized between Iran and Saudi Arabia, how do you see that playing out?
Well, I think the Saudis, look at their statements today. They were quick to come out and condemn the Israeli action. They were quick to release a statement that the Saudi foreign minister had called the Iranian foreign minister. They do not want this conflict, in part because they've invested so heavily in their own economic transformation plan. Right. They have significant infrastructure on the Red Sea. Tourism is a key component of Vision 2030. So having a better security environment, ensuring that the Houthis do not target their infrastructure, do not target Red Sea infrastructure, top priority of the Saudi government.
Okay. Halima, Pippa, thank you.
Thank you.
Well, up next, a short time ago, Iran retaliating, sending missiles into Israel. What could be the next step in this conflict? Should we expect more attacks from both sides? We will discuss that next on Overtime.
Rated PG.
Welcome back to Overtime. Shares of Walmart falling a bit today. That extends the stock's losing streak to 8 days. Last time it had a losing streak as long as 8 sessions was 2014. That's about 11 years ago. It's still up 4% for the year, though. On the other hand, we've got Tesla up for the 5th time in 6 sessions. At the peak of the day today, the stock had recovered all the losses from last week's Trump-Musk feud. Now let's bring in senior markets commentator Mike Santoli for more on the market's reaction to the Middle East flare-up. Mike.
Yeah, John, so far you would have to say relatively contained. And then, by the way, that move in Tesla you just mentioned, as well as the pop continuing in Oracle, really did mitigate the damage in the S&P 500, but it's brought it back down to levels seen, a week ago Thursday. Interesting staying above, the May high. That's also the 20-day moving average. Yes, 20-day. That's sometimes a short-term trend line you want to keep an eye on to see if anything's changing about the tone of the market. I think we can go down, 3 or 4% from here, and it's still on the chart going to look routine. Who knows if the news flow is going to seem routine? Who knows if there's going to be other elements that are flaring up along the way? But right now, you're working from a pretty good cushion that was built up from the April lows. That said, 10% on a one-year basis, that's fine. That's not too far from the historical average. But from the July highs of last year, it's a good deal less than that. So the market's actually been sort of having a labored time of getting beyond this general area. Take a look at the Goldman Sachs Commodity Index over 5 years. I want to point this out because you have this spike in oil. We're talking about that just now. But in general, really contained. So since the Ukraine war spike, it's been pretty much hovering below these levels, and it's not something that seems like it's feeding through necessarily to broad goods-driven inflation. Want to take a look at the volatility index. That did wake up today, and it actually has not fully relaxed. It never got down below much more than 17 or so on this big rally. But in perspective, 20 or thereabouts is kind of like we're on alert, but we're not necessarily just paying hand over fist for downside protection. So keep that in mind here. Sometimes it's the boundary between normal market conditions and agitated ones, John.
Mike, if we can pull that first chart back up, I think it was the S&P. To what degree do you get the sense that investors are just, after this crazy year, especially post beginning of April, they're shy on reacting too much to macro headlines, macro issues after the Trump policy trade? I mean, if you took all that too seriously, you missed out on a lot of money.
Yes, and I think that there are echoes of what happened back in 2020. People have been pointing to that, right? After the market came roaring back from the COVID crash, that was kind of like, well, what doesn't kill you makes you stronger, so you might as well just err on the side of buying sooner when you get a pullback than not. Now, it only lasts for so long. You can't have a real deterioration of the fundamentals and still have that, keep that brave face on for the overall market. But I do think that dynamic is at work here, that we so recently felt burned for getting scared out of the market that maybe we're going to try to lean in the direction of maybe things will turn out okay this time.
The old Kelly Clarkson trade. Mike Santoli, see you again in just a bit. Yep. Well, it's time for a CNBC News update with Kate Rogers. Kate.
Hi, John. The Trump administration says it doesn't plan to release pro-Palestinian activist Mahmoud Khalil. That is despite a federal judge's ruling this week that Khalil cannot be deported or detained based on Secretary of State Marco Rubio's determination that he's a threat to national security. U.S. attorneys said in a letter today that they would keep holding Khalil on other charges such as immigration fraud. About 200 Marines have moved into Los Angeles amid protest against President Trump's immigration crackdown. The commander in charge of the deployment said today that those Marines will protect federal property and personnel. It comes a day after a federal appeals court ruled the administration can, for now, maintain control of the National Guard members in California. More protests are set to take place this weekend nationwide. And deliberations are underway in the murder retrial of Karen Reed. Reed is accused of fatally hitting her Boston police officer boyfriend with her SUV and leaving him to die in the snow outside of a house party. Her defense team has said she is the victim of a police conspiracy. John, back over to you.
Okay, thank you. Stocks sinking late in the session as the Iran launch of retaliatory missiles strike at Israel. Does this latest flare-up of violence make a nuclear deal with Iran more or less likely? What happens next from here? We'll discuss coming up on Overtime.